We are looking live at Nuburu Inc., ticker symbol BURU, which is currently trading at $0.3532, and it is having a rough session, down about 5.95% on the day. But that price and that intraday drop is perhaps the most misleading piece of information you could look at. The real story is the volume. We are barely past midday, and 64.8 million shares have already changed hands. This is on a stock with a public float that has been estimated by some retail forums to be under 20 million shares, though its total outstanding shares are much higher. This is a level of activity that signals an intense, high-stakes battle over the future of a company that most of the market had, frankly, written off for dead. And that's the hook. You might see a 35-cent stock and think, worthless, but the market is suddenly acting like this is one of the most interesting assets on the board. The expectation is that this is just another failing microcap, a victim of the post-SPAC boom, bleeding out into oblivion. The reality is that this company is in the middle of a strategic pivot, so aggressive, so desperate, and so far removed from its original business that it has completely reset the narrative, igniting a 175% rally in just the last 30 days. Today's drop looks like profit-taking, but the war for control here is just getting started. Let's establish what everyone believes. The common ground is that Nuburu, by its original metrics, is a financial disaster. This is not an exaggeration. The company's own SEC filings, specifically its 10Q report from May of this year for the quarter ending March 31, 2025, painted a picture of absolute collapse. It reported $0 in revenue. Not low revenue, zero. It posted a net loss of $14 million. It had defaulted on its property lease and as a result had to write down its inventory, property, and equipment to zero. The report contained the dreaded going concern warning, the accounting language for we may not survive. The stock plumbed all-time lows of around 12 cents in September. From that perspective, any investor would be right to assume this company is finished, but that's where the reality check comes in. Starting in late September, a flurry of news suggests a complete boardroom coup and a strategic lurch into an entirely new business, defense technology, security, and even software as a service. The company many investors thought they knew, the one making blue lasers for welding batteries, effectively no longer exists. It is being hollowed out and rebuilt as a new entity, and this is where the volatility is coming from. The timeline of this recent activity is everything. On September 29, the company issued a strategic update. It announced the creation of a new subsidiary, Nuburu Defense LLC. It also confirmed it had just completed a $12 million public offering. This is the lifeline. That offering gave it a cash position of approximately $6 million to execute its new plan. That plan includes working with an Italian defense company, Tecne SPA, and pursuing a controlling interest in a company called Orbit SRL, which operates in the operational resilience SaaS space. Then on October 22nd, the real bombshell dropped. Nuburu announced a strategic framework agreement with Maddox Defense to form a joint venture focused on advanced drone systems. This JV, which will be controlled by Nuburu Defense, is targeting the NATO UAV defense market, an opportunity they estimate at over $7 billion annually. The press release was exceptionally bold, projecting that this new JV could reach $100 million in annual revenue by 2028. For a company that reported zero revenue just months ago, this is the kind of projection that forces a total reevaluation. The stock, predictably, surged 25% in the pre-market on that news. This is the fuel for the 175% one-month gain. We've also seen other corporate changes, like the implementation of a dual CEO structure on October 1, a move so abrupt that it earned the company a warning letter from the NYSE American Exchange on October 13th for failing to provide advance notification of material news. This signals that management is moving with frantic speed, perhaps even faster than its own compliance department can keep up with. This brings us to the short-selling dynamics, which are absolutely central to the BURU story. When you have financials like Nuburu's, you attract short sellers. The short thesis is, or at least was, one of the easiest on the market. The company is insolvent, generates no sales, and is burning cash it does not have. It was a clear-cut bet on zero. You can see this reflected in the stock's long, painful decline to 12 cents. But this recent pivot has thrown a grenade into that thesis. The $12 million in cash resets the clock on bankruptcy. The defense and drone JVs, while speculative, now offer a non-zero chance of future revenue. This creates a classic standoff. The original shorts are likely still holding, believing this pivot is just a Hail Mary destined to fail. But new speculative buyers and, perhaps short sellers covering their positions are driving this immense volume. Institutional ownership is incredibly low, at just over 1%. Vanguard and Geode, through index funds, are the largest holders, but this is a passive position. This means the stock is almost entirely in the hands of retail traders and a few hedge funds. The borrow fee rate, or the cost to borrow shares to short, is a critical metric to watch here. While I don't have the live data on my screen, for a low-float, high-volatility stock like this, that rate can spike into the triple digits, putting immense pressure on short positions. Here is an actionable step for anyone trading this. You must find this data. Your broker's platform may show it, but dedicated services that track short interest are better. Look for the days to cover ratio. With volume at 64 million, the days to cover is likely very low, meaning shorts can exit easily. But if volume dries up and short interest remains high, that ratio expands and the potential for a squeeze builds. You also need to watch the failed to deliver data, which is published by the SEC. High FTDs can suggest naked short selling or settlement failures, often a sign of extreme stress in a stock's trading system. What's your take on the rising short interest, smart money, or manipulation? Comment below what you think is really driving the negative bets here. The risk for retail is clear. This is not a stable investment. This is a high-stakes gamble on a corporate transformation. Chasing a squeeze here is exceptionally dangerous, as the stock is just as likely to fall 50% in a day as it is to rise. The smart move is to watch the news flow. Will that Maddox Defense JV be finalized by the December 15th target? Will the company report its first dollar of revenue from these new defense or SaaS ventures in its next earnings report expected around November 13th? These are the real catalysts, not just a chart pattern on TradingView. Speaking of retail sentiment, it is, as you can imagine, running hot. You have traders on forums calling for $1.50 or even $5 a share based on the low float and the massive size of the defense market they are now targeting. This is the expectation side of the equation. The reality is that the company still only has 8 employees listed as of its last report. It is a tiny operation attempting to play in a league with giants like Lockheed Martin and Northrop Grumman. The gap between the $100 million revenue projection and the zero revenue reality is a chasm. The entire bull case rests on the belief that these new agreements and the new management team can build a billion-dollar business from the ashes of a failed one. It's a binary bet. This stock has seen a 175% run-up in the last month. Comment below if you've been part of that trade or if you're just watching this one from the sidelines. Let's briefly touch on what Nuburu used to be. Its core technology was, and technically still is, high-power blue lasers. This is genuinely interesting tech,
Blue lasers are absorbed more efficiently by metals like copper and aluminum than the more common infrared lasers. This makes them ideal for welding, particularly in battery manufacturing for electric vehicles, electronics packaging, and 3D printing. The applications are real and in high-growth sectors. The problem was that Nuburu, as a business, completely failed to commercialize this. Revenue collapsed 92% in 2024 to just $152,000, and then, as we saw, hit zero. This failure is what forced the pivot. The blue laser technology is now being marketed as a component for the new defense business, a way to integrate it into the drone and security applications. So, what is the future outlook? The expectation from bulls is that the worst is over. The $12 million financing is the floor, and the new JVs provide a path to exponential growth. The reality is that this $6 million in cash will not last long. The company will almost certainly need to raise more, which means more dilution and more share offerings that could pressure the price. The catalysts are the definitive agreement